Okay, Section T of your handouts summarizes the complete claim from start to finish. This includes all SR&ED related tax forms in various sections. So what I'll do is I'll walk a quick overview through the forms themselves, and then we're going to go into detail on each of the specific forms by section. The first of the federal schedules that we're going to examine is the form called T661, also referred to as Schedule 32. That's a summary of the actual SR&ED expenses and the amounts that are qualified to earn SR&ED tax credits. There's no actual tax credits calculated in the T661 form. It's just the expenses and the amounts that another form is going to use to calculate the credits themselves. Now, one thing to mention about this form is it's one of the few forms you're going to see that still has two names. It's referred to as Schedule 32, and it's also referred to by its old name, Form T661. Why does the CRA keep two names for the same form, other than to confuse people? The main reason is that there's a bunch of interpretation bulletins and information circulars, which are specific papers that are developed over the last 20 years that still are in force and still refer to a Form T661. So for ubiquity, the CRA uses those two terms interchangeably rather than replacing all the paper copies right away of the old forms that still refer to the T661. Those are synonymous. So Schedule 32 and T661 mean exactly the same thing and can be used interchangeably. So in Section T1, we're going to go through a completed claim, both the financial and project description components of the T661. The T2s of your handouts, all the pages numbered T2.1, T2.2 onwards, talk about the actual ITCs that we're going to earn. So Schedule 31 calculates the ITC rate, whether we get a 35% ITC or a 20% ITC, i.e. whether we're a qualified CCPC, what our expenditure limit is of the $3 million limit, how much of that's eligible or available to earn the 35% ITCs. Versus 20% ITCs. And then which of those ITCs are applied against income taxes payable due to taxable income that we have versus refunded or carried forward. So all of those calculations, the ITCs themselves, as well as what happens to the ITCs, whether they're applied against tax, refunded, or carried forward, is all determined within Schedule 31. Schedule 49 is another important schedule that we want to consider or contemplate with Schedule 31. It shows us all our associated corporations, including the expenditure limits as a result of that. So what their taxable incomes were in the prior taxation year and what the assets employed in Canada, otherwise known as their taxable capital, was to, again, determine if there's any phase-outs of our $3 million expenditure limit for the enhanced credits. Okay. T3s of our course materials, so Section 3 of the T section, is Schedule 1. That's the reconciliation of financial statement income, whatever we say on our financial statements as net income, to taxable income. So every tax return has to basically take our financial statement income and adjust it for certain expenses or adjustments that the CRA say may be deductible for tax purposes, but not for financial statement purposes, and vice versa. Okay? A good example on any company would be meals and entertainment expenses, which on your financial statement you deduct all your meals and entertainment expenses to the extent that they're incurred for producing business income, yet on the tax return they may be limited to 50% to represent that there's a personal component or benefit to that. Okay? So financial statement income generally does not equal taxable income. There's often timing differences and permanent differences that will cause one to vary from another from year to year, either temporarily or permanently. Okay? So we're going to talk about Schedule 1 and how those reconcile. T4s show some schedules that I think are sometimes necessary for non-arm's length expenses. So these are forms that are used to transfer either costs and or expenses as necessary when we have a non-arm's length transaction. The T1174 form is also used where I have an employee who's a specified employee of more than one company. And as we've talked about in another section, there's a certain limit of 5 times yearly maximum pensionable earnings, or roughly $240,000 to $250,000 that we can claim for such an employee in any given taxation year. The 1174 form comes in and asks us how much income that employee's made across all of these companies to make sure that by splitting that individual across more companies, we don't exceed that limit. So again, these are forms that are now required as part of the prescribed form. If they apply, you need to file them with the tax return. In our example, we've also assumed that all the costs were incurred in Ontario. Again, each province basically has its own level of SR&ED tax credits and a related form. All of the provinces except Quebec are agreeing provinces, which means you file the provincial forms with the federal tax return. If the CR agrees to it, then the provincial allocations are assessed at the same time. Quebec reviews its own forms and requires a separate disclosure. So again, you may get federal concurrence on the technology side. If it's technologically eligible, i.e. science eligible from the CRA, Quebec will accept it, but they have their own issues on reviewing the financial costs. Okay? So in our Ontario schedules, we've shown a calculation of the Ontario Innovation Tax Credit, a 10% fully refundable credit. We've shown the calculation of the Ontario Research and Development Tax Credit, which is a 4.5% non-refundable tax credit. And within that, the differences between those, that if we have a non-refundable tax credit as a provincial credit, it becomes taxable in the year that it's earned. So if a company's in a loss position, it may in turn choose to renounce or refuse that non-refundable credit in an effort to get more cash flows now. The rationale for that is if we claim a non-refundable credit, it's taxable in the year, so it becomes taxable income, and it also becomes government assistance for calculating our refundable credits. So claiming the 4.5% ORDTC is going to reduce our 10% fully refundable OITC and our 35% fully refundable federal ITC, which is in cash in our pocket now. Again, so very often you'll see companies renounce a non-refundable ITC, which means maybe we're looking at more money down the road in order to get more money today based on that. Okay? The last of the Ontario credits that we illustrate here is something called the OBRI, or Ontario Business Research Institute credit, which is a 20% fully refundable credit for any company that does work with a Canadian or an Ontario university. So it could be a public company doing work, hiring the university, or a small company, doesn't matter. If we pay them on the first $20 million a year, we can get a 20% credit. Now we'll illustrate the tax credit claim using a quick overview as the results of the form. So the first section is to determine the costs that are eligible for deduction. These are generally called eligible expenses in the Income Tax Act. And we'll differentiate them from Section 2, qualified expenditures, which means expenditures that earn the tax credits. So the eligible expenditures for deduction include our wages, materials, payments to subcontractors, in this case third-party payments, or payment to university of $50,000 here. Our expenses will also include an allocation for capital equipment, in this case $15,000 for equipment that's intended to be used 90% or more of its economic life in SR&ED activities. And in such a case, we get to deduct the full amount, the full $15,000 that we paid for that equipment in the year of acquisition. Okay? So what we have here is $520,000 of current expenditures and $535,000 when we factor in the capital of total expenditures of what we can deduct as an expense for income tax purposes in the taxation year. Section 2 then says, what adjustments do we make to the eligible expenditures to determine the amounts that are qualified for investment tax credit? Now in this situation, we've elected to use the proxy amount for overhead allocation. So that means in the expenses above, under traditional overhead, we've said we don't have any traditional overhead expenses for SR&ED. In other words, any of those overhead expenses we will just deduct as regular expenses as we would on our income tax return as if we weren't doing R&D. Okay? Just as a regular expense, not as an SR&ED expense. And in lieu of that, what they say is that we take our SR&ED wages of $400,000 calculated above and multiply that by roughly 65%, and that's deemed to be the SR&ED overhead amount that we will use to calculate the investment tax credits. Okay? So in this case, it's $260,000. So we have $520,000 of current expenditures that are eligible and another $260,000 of qualified expenditures, meaning that on the $520,000 of direct current expenditures, we have $780,000 of qualified expenditures for investment tax credits. And again, the $15,000 of capital would just carry forward as a qualified expenditure for SR&ED as well. Okay. If we scroll down to the next two sections, sections 3 and 4, we now look at the tax credit calculation. So once we've determined the base for calculating the tax credits, the ordering goes as follows. We determine which province the work was done in and claim the related provincial credits. In this case, we have an Ontario Innovation Tax Credit of 10%, and we have a 4.5% Ontario Research and Development Tax Credit. We've claimed both of those. In this particular scenario, we've also had a $50,000 payment to an Ontario University, University of Toronto in this case, so we get another 20% credit on that, or $10,000. So that means on our $780,000 of direct expenditures, we have to deduct all of our Ontario-related tax credits here to get our net amount for federal tax credit. Once we deduct that net amount, we take the remainder and multiply that amount by 35%, being roughly $229,000. So on our $656,000 base for federal ITCs, we have roughly $230,000 of federal credits. What this means in a nutshell is on our $520,000 of direct current expenditures, we have roughly $330,000 of cash refunds at the end of the day, albeit distributed across the provincial credits and the federal credits. Okay? Section 4 at the bottom shows the actual after-tax cost of the ITCs. So what happens here is we get the credits themselves. We have to pay federal and provincial taxes, assuming that we're a Canadian-controlled private corporation on active business income in Ontario. That would be roughly 18%. So we take our credit amount, determine the 18% of taxes that we're eventually going to have to pay on those credits to get our net cost after tax. If we take the amounts on our tax summary, our total project costs, now we'll illustrate how it goes on a form. So on the bottom of page T1.3 of your handouts, we actually have the T661 form itself, and we're going through the various lines to illustrate the costs in question. So our lines 300 and 305 are our wages. We're the wages for the regular employees and the specified employees to get the total wages of the $400,000. You'll notice there's also a line a little later on, line 315 over to the left, that says what were the unpaid amounts, i.e. amounts that we accrued to someone but we haven't paid within 180 days a year end. In this example, we haven't got any, but let's say we accrued some amounts payable to someone and hadn't paid it, but we want to have that work reviewed so that if we do ultimately pay that person, it would be an SR&D expense. We would put those costs on line 315 here. Okay? We also now go through the other expenses, the materials, the payments to subcontractors, both arm's length contractors and non-arm's length. If we have a company under our own control or a related party, that would be a non-arm's length transaction. So a transaction in a company I control and my brother's company would be non-arm's length, something along that nature. Okay? We then have our $50,000 payment to a third party, in this case University of Toronto, third parties being different than payments to subcontractors or private type companies. Okay? To get to our total of $520,000 of expenses. As mentioned, we have our capital expenses, $15,000 of which we can put it through the pool to get 100% deduction in the year, rather than have to take capital cost allowance on the asset, which may limit it to 20 or 30% a year, depending on the class of asset itself, meaning that the total amount available for tax deduction in the year is $535,000, which is going to go to Schedule 1 or T3.1 of your course materials here as a deduction for tax purposes. As we move along, what we do is we have the calculation of the SR&ED expenditure pool itself and how this is going to show a reduction of that pool for the credits earned. So this is a complicated transaction that confuses a lot of accountants. What happens for tax purposes is we start with our qualified expenditure pool above, our $535,000, and there's certain taxation amounts. The way it works is that you pay tax on provincial credits in the year that they're earned and federal credits the year after they're used. So there's a bit of a timing difference. For financial statement purposes, we usually recognize all the credits in one year or all the credits the year after they're received. So if we're conservative, we do it the year they're received, or if we're more aggressive, we do it the year that we accrue them and try to file them. As long as we have reasonable assurance, we're going to get those credits. So in this case, the timing of the tax on the credits is different. What happens is we're taxed on the current year's provincial ITCs in the year that they're earned. So the Ontario credits are coming off the pool, okay? And the prior year's federal credits. If we didn't claim anything prior year, we don't pay any tax on it. We pay tax on our federal credits the year after they're used, either refunded or applied against tax. And we pay tax on provincial credits the year that they're earned. The implication of that is if we have a company that earns a non-refundable credit, as a lot of large companies or public companies do, 20% non-refundable credit, and they don't use it in a year, it would be unfair to make them pay tax on it, so they only pay tax on it the year if it's actually used. So in this case, we take off our federal credits and our provincial credits to get the net amount that's available for deduction here. Now, another interesting thing that we've shown here is that we have a total amount available for deduction at the end of the year of roughly $189,000. However, of $212,000, of which we've only chosen to deduct roughly $189,000, leaving $22,000 left. What would be the reasons not to deduct the full amount? Well, there could be several reasons. Your accountants may not want to deduct it. If it puts us in a loss position, we can choose to defer that amount of expense and leave it in the pool. Unlike a loss, which may expire anywhere from 7 to 20 years from the year it's incurred, an SR&ED expense in the pool is very much like a loss, except it never expires. So the government said to the extent that you can leave any of the amounts in the pool, and they're related to research expenses, we don't want to punish you as we would a normal business expense. We want to give you preferential treatment so that SR&ED related loss never has the normal risk of a loss of expiry. Okay? So this cost would be deducted as our SR&ED pool expense on T3.1 or our Schedule 1. We'll look at the mechanics of the Schedule 1 add back and deduction, add back of financial statement expenses and deduction of the pool as we get to that slide. Moving right along, what we now have is the calculation of the federal qualified expenditures and the provincial qualified expenditures. So what amounts now are we not deducting, but what amounts are we calculating the investment tax credits on? So we start with our opening eligible expenses above, and again we have certain adjustments. The main adjustments that we're going to see is a reduction at the federal amount for the provincial assistance of roughly our $125,000, $123,775. Okay? There's an in and out of the $10,000 related to the third-party payment expense, so that really has no effect on the bottom line. So what happens is we calculate our provincial qualified expenditures on the top amount of $790,000 current, $15,000 capital. Then for the federal tax credits, we deduct the provincial assistance on lines 513 and 514 to get to our net qualified expenditures on lines 557 and 558, that being $656,000 current and $14,400 capital. Okay? Those calculations then go to T2.1, which is our Schedule 31, to calculate what would be the related credits on those expenditures. A quick illustration of the proxy calculation, how there's 3 certain limits for specified employees, lesser of 3 amounts, illustrated here, and how the only adjustment for non-specified employees is to pull out the bonuses or any remuneration based on profit that were included in the original salary base, as described in Section F. Okay. Lastly, we want to weight the number of employees by type in the firm and have a completion checklist at the end of the day to make sure that we've provided all required forms. There's a quick form for third-party payments, so the payment to university. As mentioned earlier, we do not have to put a full project description in here. Just a quick description of who it was paid to, in this case University of Toronto, how it relates to our business, and how we're entitled to exploit. So again, having work done by a university is a quick way to bypass the project description process, as well as earn the additional 20% Ontario Business Research Institute credit. Okay, Section T2s of our form is the actual Schedule 31 of the tax form and the calculation of the tax credits. So here's where we're going from T1.4, so the 4th page of the T1s, our calculation of federal qualified expenditures, both current and capital, to calculate what our ITCs are. So in this case, we take our current expenditures of the $656,000 times 35% is our $229,679 federal ITC on current expenditures. We take the $14,400 net federal capital expenditures. That's the $15,000 less the $600 of Ontario credit that we got on that. So the $14,400 times 35% is $5,040. Okay, so we calculate our 35% credits on both the current and the capital. The form then illustrates that the credits on the current expenditures are fully refundable, whereas the credits on the capital expenditures are only 40% refundable. So in our case here, we have total credits in the year of $234,000, of which $231,695 will be refunded, but 60% of the $5,040 federal credit on capital is non-refundable, roughly $3,024, which, since we don't have any income taxes payable in the current year, is either carried forward for up to 20 years or can be carried back up to 3 years if we paid income tax in the prior 3 years. Okay? A quick illustration of Schedule 49, which shows any associated or related any associated companies and allocates our expenditure limit. T3.1 of your handouts is Schedule 1, which shows the reconciliation of financial statement income to taxable income. So in this case, we started with $1 of financial statement income, hypothetically. What we do is we add back our $520,000 of current expenditures in the financial statements, okay, from T1.3, so what went through our pool, before the capital, because the capital expenditures on the financial statements would still be capitalized and amortized as capital equipment. But the $520,000 of wages, materials, subcontractors, and the university payment to U of T, the third-party payment, that would have been expensed. That would be an add back on Schedule 1. So we add in the $520,000, and then we deduct the SR&ED pool, which we said we want to deduct roughly $190,000 from that, and we want to leave $22,000 in there. Okay? The other thing is, because we've now added back the full $520 on the income statement and only deducted the $190, let's say, $189, because we've paid tax on that difference, roughly $300,000 of credits, the current year provincial credits and the prior year federal credits are being taxed through. Now, the way that this is equalized out so that we don't pay tax on the credits twice is any ITCs that were accrued in the financial statements. In this case, we have a ITC accrual assumed at $330,200, which was our adjusting journal entry we recommended. Whatever we accrued in the financial statements gets pulled out of taxable income, so it's a deduction. So effectively what happens is we start with the total R&D expenses, we add those back, we deduct the pool, which has already been reduced by all the investment tax credits, and to avoid paying tax on the investment tax credits twice, since we've already had that added back, we then get a deduction for any of the actual investment tax credits accrued to the financial statements. One of our recommendations is, rather than having to do the deduction at the bottom of the $330,000 of financial statement credits, we include that in the tax provision, because that will typically always get caught on the Schedule 1 add back. Okay. Additional forms illustrate the transfer of qualified expenditures, where we have non-arm's length transactions. These forms tend to be self-explanatory, and the mechanics of the Ontario Innovation Tax Credit, how the qualified expenditures transfer from one form to another while on the way through. Okay. Summation at the end of the day is that once all the forms are completed, your summary of the forms themselves should reconcile to our T0 or what our expected tax credits are.